Hi and welcome to Carnegie in today's presentation. My name is Hjalmar and today I will present Björn Borg, a retail company with a strong brand position and a solid history of growth and profitability. We have a fair value range of 61 to 63. We want to highlight three main points about the case, which we will describe in greater detail in today's presentation. First, we have for long held the view that the Björn Borg brand is strong and the increasingly more positive perception of the brand among consumers is not fully reflected in the current valuation. Second, we see that the growth within sports apparel remains and helps driving group sales. We believe that this trend is likely to continue and add to the growth going forward. Third, we see a solid scope for margin improvement during 2024, driven by internal and external factors. The Björn Borg brand has experienced an increasingly more positive perception among customers over the last 5 years, as evident by the increase in purchase intent, both within apparel and underwear. Our case has for long been that the stronger brand perception has the potential to convert into growth and increase the group margins, and that this is not reflected in the market multiples. We still notice a 20 to 30% EV/EBIT and PE discount versus sport retail brands, but also a substantial discount versus more general retail peers. We argue that 2023 highlighted the strengths of the Björn Borg brand and that Q4 of 23 and full year 23 indicated that the brand power is being translated into financials. First, wholesale and direct consumer segments reported full year 2023 growth of 7% and 18% respectively. And the group gross margin adjusted for FX was 56% for Q4 and 55% for the full year of 2023. We argue that this is a good combination of growth and margins, although group total sales was hampered by the development within the distribution channel. Second, the full year proposed dividend of 3 SEK per share was equivalent of 100% of the 2023 EPS and 68% of the free cash flow per share. We argue that this further indicates confidence regarding the continued profitability and cash flow. Our second point is the strong growth within sports apparel. In 2015, the Björn Borg Group fully directed its focus towards sports apparel as the profile of the company. And while underwear still dominates the product mix, sports apparel has been helping driving the accelerating growth since 2016, as evident by the increased CAGR since then. Q4 marked the fourth consecutive quarter with sports apparel more than 20% of total sales, which are levels not achieved before. We argue that Björn Borg has a track record of releasing successful product collections and that adding additional sports apparel niches, such as running, lays a foundation for continued growth going forward. Our third and last point is the strong outlook for the margins in 2024. We argue that Björn Borg has a scope for margin improvement driven by external and internal factors. First, we notice that the single fastest growing channel is the own online, with a full year growth for 2023 of 18% and a 3-year CAGR of 23%, posting an impressive 18% operating margin for the full year of 2023 and making up 19% of the net sales for the year. Additionally, the number of own stores has been reduced during the year, adding to the overall profitability level of the direct consumer channel. Both these factors will create a good channel mix going into 2024. The channel mix is burdened by the high margin distribution channel being challenged, but we project that the net effect will be clearly positive for the group. On the group level, the current level of Euro versus SEK and USD versus SEK will create a tailwind with regards to purchase prices for the full year of 2024, which along with the projected strong pricing power sets the basis for strong gross margins for the full year 2024. The level of operating expenses in relation to sales have also been reduced following the savings initiatives during the pandemic. and we believe that many of the reduced fixed operating expenses will keep total costs on attractive levels. In total, we see a good basis for margin expansion into 2024. To summarize, we argue that the long-term case for improvement in brand reception is now starting to show in the financials. We also see a good ground for maintained strong growth within the sports apparel segment. Finally, we see a solid scope for margin improvement into 2024. Thanks for watching.